businesses, we now move from anticipating policy changes to understanding how they will be implemented and what they mean for our organizations. At AmCham Kenya, our mission is to support an enabling business environment that promotes investment, competitiveness, and sustainable economic growth. An important part of that mission is ensuring our members have access to timely information, expert analysis, and constructive dialogue on policy developments shaping the business landscape. The Finance Act is more than a tax statute. It influences cost of doing business, investment decisions, operating planning, and compliance obligations, as well as ultimately business confidence. For companies operating in the country, whether local or multinational corporations and investors, the ability to understand and respond effectively to these changes is essential. Our objective is not to simply review legislation, but to translate it into practical business insight. In this context, we really appreciate those who were able to join the session we held yesterday with the Ministry of Investment, Trade, and Industry to really have very constructive discussion about the direction we're taking with policy and legislation in this country. We want today's discussion to help organizations understand the implications of this act, identify opportunities and risks, and make informed strategic decisions. Kenya continues to be one of the region's most dynamic investment destinations. Sustaining that position requires a fiscal framework that supports revenue mobilization while also encouraging innovation, investment, and enterprise growth. As the private sector, we remain committed to working collaboratively with the government to achieve these shared objectives. I encourage everyone to make today's session as interactive as possible. Ask questions, share your experiences, and engage openly with our experts. The value of today's forum lies not only in the presentations, but also in the quality of the discussions and the practical insights we generate together. Thank you once again for joining us. Now, to set the stage, it is my pleasure to invite Fred Kimotho, Associate Director at Deloitte and Chair of the AmCham Tax Task Force, to present an overview of AmCham's finance bill submissions and a technical analysis of the Finance Act 2026. Welcome, Fred.
Thank you very much, Paul, for that introduction. I hope you can hear me and you can see me.
Yes.
Very well. Thank you very much. Thanks again, Paul, for that introduction, and good morning, delegates. Today is a very important day, as Paul has actually put it. We just want to go through the Finance Act. So we have put together a panel of tax professionals who will take us through the Finance Act, a very important process that we went through this particular financial year. And to start with, we just want to, just walk through some of the changes that we put through the finance bill before it was enacted into law. And I want to take this opportunity to thank AmCham for putting us together. I think without AmCham, some of these changes would not have probably been seen going through. And also thanks a lot to the committee that is made up of professionals from different audit firms and law firms. They have actually made this whole process a success. Now, from a Finance Act perspective, I think just to look back and ask ourselves, in terms of the environment we find ourselves in terms of these particular changes. I think we have a national tax policy. I think we all are aware of it. And we have a medium-term revenue strategy that was actually put out by the government to guide the changes that we'll see from a tax environment perspective for the 3 financial years. That is financial year 2024, 25, 25, 26, and 26, 27, which is, of course, ending in June 2027. So would have expected probably to see most of the pronouncements made in the medium-term revenue strategy come true under this Finance Act, given that it is the one, it is final, it is the last one under this medium-term revenue strategy. Unfortunately, we seem to be lagging behind in terms of what had been pronounced in those particular documents. And this is just a summary of some of the changes that we did expect in that particular Finance Act, given that it is the final one, as I have mentioned. So what it does mention is that there would have been a reduction of the corporate income tax rate from 30% to 28%. That has not come to fruition. So we also have review of harmonization of non-resident withholding tax with review of resident rates. That also has not been done. There was also a pronouncement of progressive phase out of preferential corporate income tax rates. That has also not probably been done. There was also a proposal, or rather a pronouncement in the medium-term revenue strategy that there was going to be withholding tax on goods supplied to public entities. I think this was introduced some time back. There was a very high expectation that the personal income tax bands was going to be reviewed so that then the bands are more progressive, which has actually not been done. But I think there has been public pronouncement from the cabinet secretary that this one will probably be done in the next few months. We hope it will actually be done, because Kenya, even if you compare with most of the peers across Africa, our tax bands are not as progressive as we would expect them to be. There was also a pronouncement that there will be implementation of what we call exemption of the pension regime. This has actually been done. But from a VAT legislation perspective, the medium-term revenue strategy had actually mentioned that the threshold will be moved from the 5 billion Kenya shillings that we have to 8 million Kenya shillings, which is the annual turnover that is expected for you to be able to hit the registration threshold. This has not been done. Actually, in the reverse, what we had seen in the bill was a proposal that was indirectly going actually to do away with the threshold of even the 5 million. So we do think that this is probably going against what is the medium-term revenue strategy. In the medium-term revenue strategy, there was also a proposal that the VAT standard rate was going to be reduced by 1% in 24-25 and by another 1% in 26-27. So that would have led us to 14%. But unfortunately, that has also not been done. There's a very broad proposal there that the VAT exemptions will be rationalized, to move things from exempt regime to zero rating. To move things from zero rating to probably taxable regime, and also reduce the exemption list that we do have. There was an attempt to do that, but probably it was not achieved under the bill. There's also a proposal to introduce what we call the carbon tax, including motor vehicle circulation tax, which was actually in the finance bill of 2024. Of course, that is not one thing that maybe most of the taxpayers did expect, but luckily it has also not been introduced. So in very broad terms, the medium-term revenue strategy, we do not think that probably we are tracking very well as far as the medium-term revenue strategy is concerned. But probably over the last 3 years, we have probably achieved some achievements here and there, as we'll see in the Finance Act of 2026. And I think what AmCham continues to advocate for is probably fidelity to some of the policy documents that we have put out there. Key among them is a national tax policy, where we probably would want to see a lot of predictability as far as taxes are concerned. I think in the Finance Bill of 2026, we did see quite a number of changes that had been proposed, yet those changes had actually come in the Finance Act of 2025, which is not, of course, good for the tax policy in Kenya. So we hope that we will pay fidelity to those documents as we go along. Now, straight into some of the proposals that we had put in. I think for the Finance Act, and our team here will take us through the specific changes in a lot of more detail. But some of the wins that we do consider that came out from the advocacy efforts that AmCham and other stakeholders did were some of them that I'll actually mention in this particular conversation. And one of those is actually deemed dividend distribution. There's a proposal under the bill that the commissioner can actually deem distribution of 60%, 60% of undistributed profits to be deemed distribution of dividends, in which case then it would trigger withholding tax on dividends. So from the various stakeholders and AmCham as part of those particular stakeholders, this particular provision was deleted, which is a step towards the right direction. We do believe that what is currently under the law is sufficient because it affords both the taxpayer and the commissioner to actually agree on a percentage. We did think that the 60% threshold was quite high. As a result, then that is why AmCham did advocate that this one should be removed, which we are happy to report that it was actually dropped. There was also a proposal to change the taxation regime of mobile phones. As we all know, currently we have VAT, we have excess duty, and we have import duties on mobile phones. So the key thing here is that the government was proposing to change this particular regime and only retain what we call excess duty at the rate of 25% on all mobile phones sold in Kenya and probably eliminate all the other taxes. While it can be seen like it was a very progressive sort of a move, we did think that it had two major challenges. One of them is that it was going to disadvantage local manufacturers of mobile phones because then, of course, we are moving the local manufacturing of mobile phones from zero rated to VAT exempt, which of course would make those particular gadgets a bit more expensive. And of course, making local manufacturers' taxes appear the same as imported phones then would have made local manufacturing a bit more non-competitive. And I think the broad policy is that the government would want to encourage local manufacturing. So I think that was one of the major challenges. But the second one, and most importantly, is that the 25% excess duty was going to be imposed upon activation of phones. Obviously, we did see a challenge with that, given that there were no regulations that have been put out. So there was going to be a huge administrative challenge, especially if this was going to be imposed on the dealers and manufacturers of mobile phones. Although the letter and the spirit of the law, it appeared like it was going to be imposed on the consumer. So we did think that it is important that that framework is put in place so that then there are no administrative challenges, and most importantly also, there's no revenue leakage. So I think for record, AmCham would probably support this perspective, but I think it needs a bit of more time to be thought through and things to be put out very clear in terms of how the taxation will happen. There was also a proposal to impose excess duty on grass bottles that are imported from East African community. And I think this is not the only proposal. There was quite a number of proposals that were going to impose excess duty on goods that are imported from East African community, which was, of course, going to be, to bring a bit of trading consistencies. And that's why then AmCham did think that this was not a good proposal. And as a result, we did submit on this as well. And I'm happy to say that the committee took it in consideration, and they did drop that particular proposal. There was a huge proposal on agency notices. As we all know, today, if you look at Section 14E of the Tax Procedures Act, there's a clear provision that bars the commissioner from correcting any form of taxes should you receive, an unfavorable ruling from the tax appeals tribunal and you want to appeal at the High Court. So what the law provides for is that the commissioner cannot come after you to the extent that you have lodged an appeal within the required time frame at the High Court level. So the proposal was then to delete that particular provision, and I think the effort was to ensure that the commissioner then does correct the taxes if you lose at the tax appeals tribunal. We did think that that is very progressive. Looking at the constitution, of course, in terms of access to justice for taxpayers, and many other factors that we thought that would not sit very well with that particular proposal. And good to mention that this proposal was actually coming almost for the fifth time in a row. Unfortunately, actually, what we saw in Parliament was actually even a worse proposal, because what Parliament was proposing is that should you lose a case at the Tax Appeals Tribunal, you are supposed to pay 100% of the principal taxes, that you have probably lost. And luckily, that was lost on the floor. But I think for us is just to see to note that there's actually a very renewed effort to have this particular proposal in the law. I think it is us to see the mischief that the government is trying to cure and probably work together to ensure that we don't have a worse legislation that like we would have had, assuming that particular proposal that was put on the floor of Parliament did go through. So it's something that we will keep monitoring, and where possible, I think we can work closely with the policymakers just to ensure that it is not an adverse proposal that is put in the upcoming bills. There's also a proposal to review the computation of time, for tax disputes. For example, if you receive an assessment, currently what we do is to count 30 working days. What that does is to remove the weekends and the public holidays. So it gives the taxpayers a bit of more time, to come up with the objection and good grounds of objection for that matter. So there was a proposal then to remove that and just have calendar days, which was going to deprive the taxpayers the much needed window for that particular purpose. But luckily, that was also dropped. So I think those are some of the key wins from the advocacy that AmCham and other stakeholders did put together. And we are happy to have been part of that particular process. And maybe more specifically on a high level, before I hand it over to my colleague Ken, who will take us through the specific changes that we did see under the direct taxes. So for income tax and some of the changes that we did specifically submit on, and probably also not taken, is the expansion of scope from a withholding tax perspective, on what the government is saying that they are seeking to tax the non-resident card companies. So there was a proposal to expand the definition of loyalty and also management fee, basically to capture two things. One is the interchange fees that bank pay among each other, which is obviously local, and also the payments that are made to card companies. When you use your cards. Unfortunately, these two proposals were retained in the bill. And what we saw is a bit of misinformation, because I think what the government does think is that the card companies are not paying any form of taxes in Kenya, which is not very accurate, because they actually do pay different forms of taxes. But it appears like this was probably not had. And I think what AmCham continues to advocate for, if you look at Kenya, for example, from a withholding tax perspective, the rates are quite steep. They actually, most of the rates are 20%, especially where you don't have a double tax agreement. And as a result, this makes Kenya a bit uncompetitive. And I think the other thing that we have tried to advocate for is for the policymakers to actually see withholding tax not as a very good tool, or as a very good tool of expanding the tax base. Because what happens for non-resident especially is that the non-resident persons actually do redesign their contracts, so that burden is actually imposed on the local consumers at the end of the day. So I think from a policy perspective, what we would probably want to see is a more thought through sort of tax that will not find its way back to the local consumers. And there are some of them globally, and even Kenya. We have the so-called significant economic presence tax, for example, that is imposed on the income that a company derives from Kenya on digital transactions. So we do think that this is maybe the right way to go, but not withholding tax. But maybe that one now we'll have to look at it in the coming days. There's also a proposal on non-resident rental income tax, which also the proposals by AmCham one probably not taken into account. I did talk about the deemed dividends, which we are happy to report that it was actually dropped. there was a proposal that was seeking to reduce the deadline or the window within which taxpayers can file from 6 months to 4 months. Luckily, after various consultations and the stakeholder submissions, this was retained for entities or for non-individuals. But for individuals, it was reduced to 4 months successfully. We do think that this is a win for companies because based on where we are now, I think the 6 months are quite helpful as far as filing is concerned. There was a proposal on the indirect transfer of shares. And what this proposal seeks to do is to remove the threshold. Currently, we have like 20%, where an unresident person derives value from disposal of property located in Kenya. The current threshold is 20%. Actually, globally is like 50% or thereabout. This proposal was seeking to actually remove that particular threshold, and unfortunately, that did go through. So, for businesses, then you would want to think through your restructuring and disposals at global level, because then indirect transfers may trigger capital gains tax in Kenya. Given that the threshold is probably now not there. I've talked about the mobile phones, and I think there's good news there that the Committee on Finance did drop that particular proposal, and I think, as I have mentioned, it's just a matter of time, so then it is thought through in a proper manner. Yeah, so and I think also from an IDF and RDL perspective, it's more on mobile phones, which I've indeed mentioned that this probably will be reviewed. And for now, we do have to retain the status quo. So our delegates, those are some of the changes that we do think were important to mention to us in this particular forum. Of course, there are so many other changes. There's mixed bag in terms of what the finance bill did bring. I know some of us are happy with what they're seeing in the Finance Act. Some of us are obviously not very happy. But I think as AmCham is to continue advocating for a sound tax policy, a predictable one, that taxpayers are able to predict and model their activities around with a bit of certainty. So without much ado, I'll hand over the mic to my colleague, Ken, to take us through the specific changes that we did see under the Finance Act from an income tax perspective. Over to you.
Thanks, Fred. I think we'll transition to the panelist session, and I'll be the moderator of a panelist. Together, I'm joined with my colleagues, Ken Njuguna from ALN Law Firm, and then we have Beatrice Dungu from KPMG, and also we have Andrew Warambu, a partner at Dentons. I think we'll transition quickly, and the first question will be to Ken. Is the current Finance Act 2026 a success, a missed opportunity, or a source of fresh challenge?
Thank you, Nicholas, and good morning, everyone. Thank you, Fred, for that very succinct summary. I think the Finance Act of 2026 is it's a mixed bag. There are some successes from what we've heard from Fred. There were lots of proposals by stakeholders, including AmCham, which Parliament listened to. So there are a number of retrogressive proposals which were dropped, which is a very welcome move because it demonstrates that Parliament does listen to stakeholders. But also, part of the successes are around the fact that we've seen a greater focus on tax administration as opposed to new taxes, as has been the case in past years, which of course is a welcome move. We've seen some investment-friendly measures, for example, some limitation on loss carry forward being removed for large investments, some new capital allowances for large investments. Still, lots of ground to be covered in terms of, as Fred said, certainty and predictability of the tax regime. But the good thing is there were some successes. Of course, lots of missed opportunities. There was a lot of anticipation that we would see some PAYE reform. And the rationale for all the lobby efforts around PAYE reform is to ensure that there is more disposable income to stimulate consumption. And currently, employers are bearing a lot of burden when it comes to some of these employment levies, taxes, and so on. So that was certainly a missed opportunity. Government has made promises that they have not forgotten, and they're still looking into it. So we're going to wait, hopefully, over the next 6-12 months to then see if we're going to see any changes in that regard. Also, there are very few measures aimed at stimulating investment, particularly enhancing FDI, which is a big concern because for our economy to grow, we expect that we need to attract and encourage investment, domestic and foreign investment. We haven't seen much of that. We haven't seen much of initiative around job creation. And these are issues that stakeholders, I'm sure, will continue to submit on so that we do have very clear measures that are going to enhance and encourage investment. Now, we expect that we're going to see fresh challenges arising out of this new Finance Act, particularly all the compliance obligations that are generated by technology-driven tax administration. As you may all be aware, of the last 2 years or so, we've seen a drive towards technology-driven compliance, so requirement to have electronic tax invoices, pre-populated tax returns, and so on. And it's just a matter of time before we start seeing fresh disputes arising out of these new changes. Quite novel, difficult to predict how these disputes are going to turn out, but we expect that over the next couple of years, we're going to see increased scrutiny by the Revenue Authority on compliance, data-driven compliance, and a fresh wave of disputes arising out of these new measures that have been introduced. Of course, we do have a challenge of ambiguity and interpretation of some of these new changes, particularly when it comes to aspects relating to card payments, which I will discuss later, and some of the new changes around the capital gains tax regime. Again, these are areas where we expect challenges and certainly a fresh wave of disputes in the coming months in terms of what do these changes really mean? How should they be interpreted? Which is a concern because most of these provisions came into force on 1st of July, 2 days ago. So taxpayers did not have much time to understand the changes, get clarity on what some of these provisions mean or are supposed to achieve. So it's going to be an interesting couple of months as we wait and see how the Revenue Authority interprets these provisions. Thank you, Nicholas.
Thanks a lot, Ken, for that clear response. I'll be moving on to Beatrice. Over the last couple of cycles of Finance Act, we have seen revenue mobilization being one of the key mantra that's been posed by the government. Does the current Finance Act 2026 strike a right balance between revenue mobilization as well as supporting business growth?
Okay, thank you, Nicholas, and good morning, everyone. That you point out a very important question, and I think in my view, the Finance Act of 2026 does a better job in balancing revenue mobilization and business growth compared to previous Finance Acts. The balance is not perfect, but it is definitely better. One of the things that you'll note with this Finance Act, we have seen a shift by the National Treasury and Revenue Authority and government in general from increasing tax rates to improving tax administration and compliance. Instead of, we have not seen a lot of clauses seeking to directly increase the tax rates. What the government has tried to do with this Finance Act is to improve compliance, give KRA more access to information. We have seen the issue of the pre-populated returns, and generally, all those things are aimed at ensuring that tax evasion is reduced, and also making it easier for KRA to really get information and to collect taxes and to bring more people into the taxation bracket. And this is one of the things that we that most stakeholders have been telling the government, that let us widen the tax base as opposed to focusing on the very few people who are still very overtaxed. So looking at it, does it strike the right balance? Not perfect balance, but it's a better balance. The only challenge that we are then likely to see with this Finance Act is, given the multiple administration clauses that have come up, you'll see companies needing to do a lot more to ensure that they are compliant, a lot of reconciliations, a lot of record keeping, and to just a lot more vigilance in ensuring that the document keeping is proper. Thank you, Nicholas.
Thanks, Beatrice. Maybe pivoting to Andrew. One of the most, can you say, contentious issues is around the enactment data, and you'll find we tend to have a very shortened time between when we pass the law and when they come into force. Yeah, and you'll find most of these tax changes tend to take effect immediately upon enactment. Should businesses be granted a structured transition period to adjust their systems, contracts, and also operating models? Over to you, Andrew.
Thank you very much, Nicholas, and good morning to everyone. The short answer to your question, Nicholas, is yes. Businesses certainly need increased timelines and allowance for them to comply with all these legislative changes. I think if you look at this current budget cycle, you had President sign the Finance Act into law on the 23rd of June, and then you have a bit of a lag in between the President signing and the actual act being available at the government printers. And if you're fortunate enough to get your hand on an official copy, you then have to comply with new taxes and changes to rates by the 1st of July. So it's a very short and compressed window that puts taxpayers under a lot of pressure, because if you look at the way business is conducted in this day and age, you have a lot of foreign suppliers and foreign customers who are not necessarily plugged into Kenya's tax landscape. And so if you have long-term contracts negotiated with people in that domain, you now have to figure out the implications on your contract. If you need to make any changes, once you work those out, you then have to change your systems in order to reflect the new taxes. And then after that, you have to make sure that you have the systems and structures and workforce in place to ensure that you can comply. I think that the issues that Ken was talking about are very pertinent. Like, if a lot of the banks have agreements with the global firms like Visa and MasterCard and American Express, if you now factor in the taxes that have been introduced, you have to figure out what the impact of those taxes is on those contracts, and then now start working towards compliance. So perhaps in the long run, I think the direction of travel we need to take is one where we have a lengthened framework that allows taxpayers sufficient time to, number one, engage with the policymakers and the legislators in terms of the proposed changes, and then also make changes. I don't think it's anything too radical, because if you look at what happens in jurisdictions such as the UK, you can have proposed tax changes that take effect 13, 14, 15 months into the future. And so maybe that's something we could borrow from some of these jurisdictions. Thanks.
Thanks, Andrew. Maybe I'll jump now to Ken again, yeah? And it's something that you had mentioned earlier. We have seen there's a trend that's happening where KRA loses a dispute at either the courts, and then we see a legislative change being proposed on the floor of the parliament, yeah? And key among one was the Supreme Court decision around ABSA case. And we have seen the Finance Act now coming to change the treatment of merchant service fees, card payment-related transactions. What are the implications for the banks, the payment processors, the fintechs, and merchants? Has the Act in itself provided more clarity for the industry that it was seeking, or are there still room for further refinement for the legislative framework?
Thanks, Nicholas. So that change has some two broad implications. Number one is from a broader policy perspective. If you take a step back, this dispute has been ongoing for almost 14 years. The main petition in the case started this many years ago. The decision was finally rendered by the Supreme Court towards the end of last year. And what that was supposed to do is to give certainty to businesses that this is the correct way of looking at these types of transactions. They are not management of professional fees, they are not royalties. And this has having gone on for over a decade, then less than 6 months later, then we see a change in law overturning what the court has clarified as being the correct position. And my concern from a policy perspective is, on one hand, investors thought they had certainty and clarity in terms of how these provisions ought to be interpreted. But then a few months later, again, that position is overturned and those provisions come into force immediately. Right? So there's a long way to go around certainty, policy, and the need to provide businesses with clarity. That's one issue. But now turning to the implications, and our firm was quite involved for two of the petitioners at the Supreme Court. Coming to the implications, I know there were lots of stakeholder comments that were provided to Parliament on this issue around what the implications are likely to be in terms of introducing, ensuring that these payments fall within the basket of withholding tax. And what we are likely to see is there will be challenges in implementation. So particularly when you look at merchant service fees, which are usually settled on a net basis. So you have net offs and so on. Applying withholding tax becomes a nightmare. There are probably system changes and all of that which may be done, but it's quite difficult to implement withholding tax obligations when payments are netted off against each other. There's hundreds of payments happening at any given point. So there's a compliance burden that is a big challenge that will be occasioned by these new changes. But over and above that, what we expect is we're going to see gross up provisions, which ultimately push the withholding tax burden to Kenyan taxpayers. What's that likely to do is card transactions are probably going to be more expensive. Me and you and everyone who uses a card to make payments are likely to probably suffer a higher burden because the banks will not likely absorb that cost. And of course, the jury is still out there, but whether this means that we may go back to cash-based transactions, where we've made great strides over the years to move to predominantly card payments in the formal sector. That will be a big mistake. It will be a big step backward. But also, are we likely to see businesses charging a markup when it comes to card transactions, which will discourage consumption, broader implications for the economy, but again, pushing back to cash payments. So it's still early days. We hopefully expect that all these policy considerations and submissions that were made by the banking sector, by the card companies and many other stakeholders will hopefully be heard once the implications over the next couple of months are then seen. I think sometimes what Parliament and government wants to see is, did you actually, whatever you said as potential implications, are they actually going to arise? I don't know whether a 6-month or a 12-month window would be sufficient for these implications to be seen in the economy so that it then sets the scene for a reversal, hopefully, in the next set of tax changes. But going back to and answering your question, I think it's a broader issue around policy. We've seen a government try to do this previously when they lost, say, the 7Cs case. They tried to change the definition of royalties. It ought not to be a trend. Otherwise, it beats logic why taxpayers then go to court to challenge decisions, and yet you have someone on the other side who has an upper hand ensuring that any precedents really don't have the force of law, because you can then change the law and really get the position that you were initially advocating for before the courts. So let's hope it's not a trend. But as we said earlier, as stakeholders, we should not tire in making submissions, ensuring that we are all speaking with one voice and pushing for the same reform agenda. Thank you, Nicholas.
Thanks, Ken. Maybe to Beatrice now, we can touch a little bit on the indirect taxes. Maybe which indirect taxes in the Finance Act 2026 are likely to have the biggest disruptive effect on businesses and why?
Thank you, Nicholas. On the indirect tax changes, we have seen a good number of the proposals that had been included in the finance bill dropped. And I know Fred has discussed that, so I'll not really go into that. I'll look at what has actually gone through in the Finance Act. I would, looking at the indirect tax changes that are likely to have the biggest destructive effect on businesses, I would highlight maybe three major areas. The first one and the biggest being taxation on digital and payment services. And this is arguably one of the ones that get across the economy, because services such as payment processing, the gateway services, settlement services, these aggregator platforms, and these other digital payment infrastructure that were previously exempt from VAT are now explicitly taxable. And this is significant because these digital payments sit at the center of today's economy, being that the economy is really moving towards digital. So that means whether a company is moving from fintechs to telecom operators, retailers, manufacturers, actually even small businesses that accept digital payments, this change affects all of them, and they can result into increased transaction costs, and will definitely also require some upgrades and updates into the billing systems and the pricing model around that. So that is likely to be one of the most far-reaching indirect tax changes. A second proposal or a second change that might not look very big, but it can be very disruptive, relates, especially for companies that are affected, relates to the clawback of input VAT or input VAT recovery, where you had claimed input VAT and the supply later becomes exempt. You'd be required to then keep track of this to ensure that once the sale becomes exempt, then whatever input VAT you had enjoyed in the past, then you're required to come back and pay that money back to the KRA. The practical implications of this is significant, because that means companies will need stronger inventory controls, more detailed VAT reconciliations, and probably even system upgrades to accurately track stock, to make sure that this is not missed, and that could create a significant compliance or administrative burden for companies. The other thing, and the last thing that is maybe notable or important to note, is the extension of the waiting period for VAT on bad debts, moving that from 2 years to 3 years. And this is especially important to note and disruptive, given the cash flow or liquidity conditions that most companies are then facing. Then this makes them wait longer to get the money that they would really need. So that would be a summary of what I think is most disruptive. And thank you, Nicholas.
Thanks a lot, Beatrice. Maybe Andrea, how will the implementation of the Finance Act 2026 provisions affect the gambling sector in terms of reshaping the operating environment for the betting and gaming companies? And you're on mute. Maybe if you can unmute.
Thanks, Nicholas. If I may be more for a minute, I think the gambling industry as a whole is probably one of the most resilient ones that we've seen over the last few years. If you look at where they are right now, they have an effective tax rate in the region of about 70% if you consider all taxes and levies that they're subject to. KRA has integrated a system with these gambling companies, and yet when you look at the data over the last 2 fiscal years, you'll see growth both in terms of the number of companies in the industry, as well as the amount of taxes that are collected from them. Case in point is that, beginning of fiscal year 24, you had about 111 companies integrated with KRA, but at the close of last fiscal year, you had 141. Taxes collected from them grew, the excise grew in the region of about 20%. So if you look at the trend over the last decade or so, you will see a lot of growth regardless of the increased efforts to tax them and sort of discourage the behavior. I expect that trend to continue. You have amendments that were introduced to sort of capture other activities within the scope of the ambit of gambling taxes. I don't expect that to deter the businesses as well as the punters who frequent these activities. I think overall you get the sense when you follow the debate and discussion, you can see that the intention is to sort of discourage and dissuade Kenyans from gambling. But given what we've seen in terms of the numbers over the last few years, maybe it's time to take an approach aside from taxes to address the underlying issues that we are trying to address, because clearly it's not working from a policy perspective. But that's my view. Thanks.
Thanks a lot, Andrew. Maybe just pivoting again to the capital gains tax landscape here, and this one is to Kenya. We have seen changes coming across, having impact on the CGT regime in Kenya. How do these changes are likely to impact businesses with Kenya operations?
Thanks, Nicholas. So what we've seen is, around 2 years ago, Kenya introduced a regime pursuant to which offshore transactions may trigger Kenyan capital gains tax. So we've always had that regime for the extractive sector, but we saw it for the first time around 2 years ago, and it appeared to be in response to, again, various disputes and transactions that are undertaken offshore, which have a Kenyan tax impact. So we already had provisions in the 8th schedule, which is our regime that taxes capital gains. What we've seen is an enhancement of that regime to the effect that any offshore sale, any offshore transaction which has a Kenyan nexus automatically triggers capital gains tax. Now, this proposal has been introduced without any threshold. And what that means, for example, let me use the case of an American company which has, amongst many other subsidiaries, a Kenyan subsidiary. So strictly speaking, a sale of shares of a listed entity in the US, for instance, may end up triggering capital gains tax, provided that entity has a Kenyan subsidiary. Same case for reorganizations. Any group reorganizations which have a Kenyan nexus and which don't meet the capital gains tax exemption criteria for groups in Kenya, again, automatically may trigger a Kenyan capital gains tax liability. There were lots of stakeholder comments on this issue, explaining that we do not require those changes because the regime that was in the law was already adequate and could have actually been enhanced without a change in legislation. But that's very concerning because, so first of all, these changes are in effect as of 2 days ago. There's absolutely no clarity as to how they're supposed to be interpreted. But the key issue is that for offshore transactions with any Kenyan nexus, parties who are transacting may probably not even be aware that whatever they may be doing offshore may have a Kenyan tax impact. Now, policing this by the Revenue Authority will be extremely challenging. There's a provision in the legislation which requires taxpayers to make a notification when some of these changes occur. We've never seen it being fully operationalized. But in any event, how the Revenue Authority will be aware of these changes in the first step, it remains to be seen. But more broadly, the challenge is the impact of these provisions on the ease of doing business. Many companies and multinationals that we've spoken to the last several weeks, once this proposal was put in, of course, are very concerned around compliance, the compliance burden, that whatever they may be doing offshore, someone always needs to wear a Kenyan hat, in addition to many other jurisdictions where they have operations on, to then ensure that someone is keeping track of share transfers, reorganizations, and so on, to make sure that someone is thinking about what the compliance obligations are. But also, more importantly, innocent parties who are buying and selling shares on a stock exchange of an entity offshore which has a Kenyan nexus may be unaware that they may be inadvertently triggering a Kenyan capital gains tax regime. So there's room for reform, and hopefully we will have more opportunities to engage with the Revenue Authority and with government in the coming months to demonstrate how impractical these changes are, but also the wrong message that it sends to businesses and to multinationals who do business in Kenya or who are looking to expand to our markets. Thank you, Nicholas.
Thanks a lot, Ken, for highlighting those impact on the CGT regime. Yeah, maybe picking up from those regimes as well as the changes that you mentioned, Beatrice. Do you think Kenyan businesses are ready for the realities of implementing the Finance Act 2026, or are they still unprepared?
Thank you, Nicholas. And the honest answer on this is that readiness for the implementation of the Finance Act varies significantly across businesses. You'll find that large corporations, banks, telecommunication companies, and some of these organizations that have robust tax experts at their disposal, they have generally been monitoring the proposed changes from when the bill was tabled, the discussions. So they had already started assessing the impact of these proposals and looking at what they would need to do. However, you'll find that many businesses, particularly SMEs, are still generally unprepared for the practical realities of implementation. The challenge is that the Finance Act is not just about paying more tax. It requires businesses to really look at how they generally operate. Some of the changes that I mentioned, including VAT on digital and payment-related services, the changes in the classification of certain goods, and the revised compliance requirements on clawback of input VAT. Some of these changes will require updates into the ERP systems for companies, changes into the invoicing processes, pricing models, and internal control. And one of the things that Andrew had highlighted, there is usually a lag between when the bill is tabled and when it is signed by the president, when it gets to the public. So you find companies have very few days. We are already into the third day. Some of these changes have already started being implemented, but you'll find there is a struggle in catching up and being able to really implement these in real time because of all those things that need to be done. And the other thing that maybe Kenneth has also highlighted in his response is that many organizations are still focused on understanding the technical aspects of these changes, and before they even start implementing them, and we're already into 3 days into when they're supposed to have been implementing them. So my overall view is that there's a lot of awareness around the Finance Act, but the implementation readiness is considerably lower. Thank you.
Thanks a lot, Beatrice. And maybe jumping on to Andrea, I've seen the government is now keen on tweaking the tax administration as a source of revenue mobilization. Yeah. My question is, do these changes resolve long outstanding problems, or do they create new ones?
Thank you, Nicholas. Again, with most of these changes, I would say it's a mixed bag. We have some positive changes to the tax administration, but also we have some not so positive ones and other issues that we probably need to keep our eyes on. Speaking about the good, I think the tax amnesty that's been introduced is fantastic, both from a taxpayer perspective and KRA perspective, because you get to clean up any outstanding issues that you may have. KRA gets to, collect more taxes without too much effort or too much struggle, which is something I guess they always like. If you look at what has happened with past amnesties, I think they've been taken up very positively by taxpayers, and KRA has sort of exceeded their expectations in terms of the collections that they've made. Second amendment that's been introduced that probably has a positive bearing on the country and touches on something that Ken spoke about earlier is allowing non-residents to open investment accounts without registering for PINs. If you look at it in the wider context of the economy, we are a net importer of capital. And so I think we need to do everything that we can do to make things easy and accessible for non-residents who want to invest in our projects and in our infrastructure and our capital markets. Hopefully we see more inflows leading from that, which is a good thing. Turning to the aspects that are not so good, I think there's a quiet amendment that's been introduced to sort of give legitimacy to KRA having these auto-populated returns, where you'll have KRA generating your returns for you and determining what your tax liability is. We operate, well, at least on paper, we operate a self-assessment system where the onus is on the taxpayer to determine their tax liability, pay and account for those taxes, and KRA then has the right to come and audit. We are slowly seeing an erosion of this system towards a more administrative-based assessment system where KRA generates the tax liability, and then now you get to contest it otherwise. It might seem small and nuanced, but if you look at how matters like this generally progress, the burden of proof still rests on the taxpayer. And so if KRA now gets to tell you what they think your tax liability is, and then you have the burden of proof in any dispute that arises, it does put taxpayers in a bit of a vulnerable position. Not to harp on too much, but also the issue that Ken spoke about, where there were moves to have taxpayers pay a percentage of taxes in disputes before appealing to the tax appeals tribunal or to the courts. I think we've seen that issue come up in the last 4 or 5 budget cycles, and thankfully it's not been passed. But I think the greater issue that remains unaddressed is the length of time that it takes to resolve tax disputes. If you look at the case he spoke about with the issue of interchange fees, that took close to 15 years to be resolved at the Supreme Court. If you look at other matters, on average it will take you 10 years to move a matter from the tax appeals tribunal to getting a decision from the Court of Appeal. And so maybe what we need to focus on is there a way that we can get expedient resolution of some of these tax disputes? And so hopefully if we can have these matters progress faster and in a fairer manner, maybe then we'll stop seeing this urge by the parliament to have taxpayers pay taxes that are yet to be determined whether or not they are payable or not. So those are the few issues I'd like to highlight in terms of tax administration. Thank you.
Thanks a lot, Andrew. And maybe back to Kenya. Business leaders are keen to ensure that they successfully navigate the Finance Act 2026 environment. Yeah, maybe in your take, what do you think the business leaders should prioritize in the next 6 to 12 months as we start the operationalization of the Finance Act 2026?
I think looking at the direction of travel, technology will play a big role in compliance going forward, based on the trends that we've seen in the previous Finance Act and in this Act as well. So I think focusing on technology and data readiness is critical, ensuring that ERP systems and processes are very alive to these changing and evolving requirements will be extremely critical. Because arising from that, we expect that businesses should prepare for increased audit activity, primarily arising because of the additional visibility in relation to data, and the fact that we're probably going to see a bit more enforcement because of all the visibility and data that will be available to the Revenue Authority. But even beyond that, what we've seen is an enhanced scope from a withholding tax perspective, which then necessitates businesses to go back and look at their contractual arrangements to then ensure, and it's on both sides, recipients of income from Kenya will need to understand whether that income may now suffer Kenyan withholding tax, what that means in terms of treaty interaction. Are there any contractual protections in those agreements, such as gross-up provisions and so on? But also for Kenyan operating businesses, then understanding, do some of these payment streams now attract tax? Because as we all know, we have very strict withholding tax obligations and payment requirements within just a few working days of payment being made. There's an obligation to then remit that tax to the Revenue Authority. So that's critical, that businesses need to look at what their contractual arrangements are. Are there new obligations that may not have been there previously that have arisen? And in certain cases, we've seen businesses then renegotiating contracts because someone will end up with an additional cost. Either a recipient will receive less, they can't recover in their country of incorporation, or a Kenyan business will then have to go back to their pockets to then pay more, which has an impact ultimately in terms of the commercial arrangements. So it's still early days, but we'd probably say that it's best to have these conversations within the month because these provisions are all live, and penalties may start accruing as soon as, say, this time next week, when we are 2 weeks into the new withholding tax obligations and requirements. So that's critical, and it's important for businesses on both sides to speak to their advisors and understand what these new obligations are likely to be. Thank you.
Thanks, Ken, for that insight. Maybe to Beatrice, yeah? The government is keen to attract and sustain long-term capital investment in Kenya, yeah? What measures do you see, especially around the indirect tax provisions in the Finance Act 2026 that aligns to this goal of the government?
Yeah, thank you, Nicholas. Looking at the Finance Act of 2026, you'd say that the indirect tax provisions are only partially aligned with the goal of attracting and sustaining long-term investment. Looking at it, on one hand, the Act supports government efforts to broaden the tax base and modernize the tax systems, particularly in the digital economy. From an investor perspective, a stable revenue framework and strong public finances are important because they then support infrastructure development and overall economic stability. But on the other hand, some of the indirect tax measures that have been proposed may increase the cost of doing business in Kenya. Good example is the application of the VAT on certain digital payment and platform services that could raise the cost of transaction across the economy. And this would affect businesses that rely heavily on digital channels to operate and to grow. In addition, the removal of a number of VAT exemptions may increase the cost of investment projects, particularly in sectors such as construction, manufacturing, infrastructure. We have seen a number of introduction of excess duty on imported MDA wood and timber products. We have also seen introduction of excess duty on some imported sanitary fittings. These are aspects that are likely to increase the overall cost of establishing and operating a business and this could have an impact on and influence investment decisions. My overall view, especially around indirect taxes, because this is an area where we see a lot of oscillations with VAT, we see a lot of movement between exempt, VATable. Something is moved from exempt to zero rated this year, the next year is moved back to exempt, the next year it's moved to VAT. Investors are likely to view predictability a lot to be more beneficial than the incentives. One would want to have a clear or some assurance that once I invest into this particular thing, having relied on the zero-rated position, that this is not going to change in the 3 or 5 years it takes for the business or for the investment that I've put forward to break even. So if the changes that have been introduced and over the last few years, and especially even in this Finance Act of 2026, if these changes are implemented consistently, supported by clear guidance and accompanied by very efficient VAT refund processes, where if I have come in knowing that my supply is zero rated, I'm expecting to get back my input VAT, then I know that within 2 or 3 months or within this duration of putting in the application, the government will pay back such kind of efficiency. Then the negative impact of some of the changes we have seen can be managed. So in general, I would say businesses are facing higher costs and greater compliance burden without having a corresponding improvement in tax administration, and this could affect investment competitiveness in the country. Thank you, Nicholas.
Thanks a lot, Beatrice. I think you teed up perfectly for my next question. That's going to Andrew in terms of now the increased cost of doing business in Kenya. Maybe Andrew on your side there, then how should companies or businesses respond to this? Over to you, Andrew.
Thanks, Nicholas. Well, I think there are only 2 possible options that companies have with regards to these increased taxes, which leads to increased costs. The first one is you either you bear the cost of these taxes and let them eat into your margin, which leads to reduced profitability. Or the second option that you have is you pass them on to consumers or the end users of the products and services that you sell. So I think you're going to see if any costs that come up because of these taxes that can be passed on to customers will definitely be passed on to customers. Actually, if I think about it, there's a third nuclear option which involves shutting down, but I don't think that most businesses are there yet. I think that the one issue that overhangs all of this is the increased taxes that we have on digital payments and that sort of thing. It will be interesting to see just what the cost implications are on transactions and what that does for pushing business towards the digital domain. So they're both direct and indirect costs that will come about because of these new taxes. And for some of them, I guess like those digital payment taxes, time will tell how those affect the economy. It's difficult to anticipate at this point. Thanks. Sorry, Nicholas, you're muted.
You're muted.
Sorry for that, yeah. And thanks, Andrew. I think we are lost of time at the moment, and I'll want just to get the key takeaway from each one of you. Yeah? What will you want the audience to remember about the Finance Act 2026? Maybe we can begin with Ken, and then we can go to Beatrice, and then we can finalize with Andrew.
I think, Nicholas, there's lots to say, and I wish, of course, we had more time. There's lots additional issues to discuss, but I think the key takeaway is around, if you look at the last 2 months or thereabouts, I think there's been a lot of value from stakeholder engagement. And that's why it was very helpful for my friend Fred to start with the wins that we got as AmCham from engaging with Parliament. So I think it should not be lost to businesses and taxpayers that there is value in stakeholder engagement. And also there's value in starting early. As we all know, the process will probably start towards the end of the year with the engagements with National Treasury and so on. So I think the key message is looking at all the proposals which were dropped and which could probably have been part of the law had there not been robust stakeholder engagement. I think the message is there's value in engaging through trade associations, through individually and so on. So the key message is let's not tire whenever there's a call for comments and submissions and so on. It does help to shape the tax framework and to engage with government constructively. Thank you.
Over to you, Beatrice.
Thank you, Nicholas. If there is one key takeaway that I would like maybe the stakeholders or to remember about this Finance Act is the clear shift by the Revenue Authority into ensuring compliance. So this calls for a lot more vigilance for companies to ensure that they manage their tax risk. It's important to look at tax risk the way other financial risks, operational risks are really looked at to ensure that companies are not exposed to unnecessary tax disputes. The other thing that maybe would be very important in the same line is to have robust processes and technology to ensure that record keeping is proper. You'll find that many tax disputes do not arise from misunderstanding of the law, but rather from poor documentation, system limitations, and such other kind of data quality issues. In this age where the Revenue Authority is clearly embracing technology, it's very important that all teams within an organization, moving from the finance, the procurement, legal, and technology teams really understand the important place that tax has to play and make sure that at all angles, the company is protected from tax risks. That would be my key takeaway. Thank you.
Thanks, Beatrice. And Andrew, your take on it.
Thanks. For me, I tend to look at this through the lens of our tax jurisprudence. I think my key takeaway from that perspective is that it feels like one step forward, two step back, and three to the side. Taxpayers really do want certainty, and the courts have done a fantastic job in giving us decisions and guidance in what the law means and how it ought to be applied. I think it's a bit unfortunate that some of these issues that have been litigated and decided that have now given taxpayers the clarity and certainty that they crave have now been undone. Specifically, the decision that we referenced earlier. So perhaps we need to keep an eye on, with existing issues that are currently being taken through the courts and the tribunal system. Maybe it's an indication of if we look at those, I think we're likely to see changes we are likely to see in future Finance Act. So that's my key takeaway. Thank you.
Thanks, Andrew, and thanks, everyone. Thanks, the panelists, for that engaging session. I'll hand over to Presi just to take us through the Q&A session. Over to you, Presi.
Thank you. Thanks so much for that, Nicholas. Thanks to the panelists as well for a very insightful session. We'll now move to Q&A. I see we only have 2 questions. Please feel free to engage us as well as we go. I see we're still within the time. So the question is from Maurice Maniki. And the question is, it's actually pretty lengthy here, so I'll just be reading it as has been posted. The Finance Act provides that where a person had, before 1st July 2025, invested at least 10 billion Kenya shillings in Kenya and had an ascertained deficit for any period before 1st July 2025, that deficit will be deemed to have occurred in 2025, year of income, and may be applied beyond the ordinary limitation period until it is extinguished. So whilst this is a welcome move and a targeted transitional relief for large investors who incurred tax losses before the current loss utilization framework took effect, from a tax policy and legal perspective, do you think that this can be seen to be discriminatory to investors whose investments are below 10 billion Kenya shillings and have tax losses, hence triggering legal disputes? Right. And who do we assign this question to? Do any of the panelists want to respond to the same? It's on the Q&A section. I'm also happy to invite Maurice on the call to speak more to this particular question. Ken, are you happy to proceed with it?
Yeah, happy to give it a try. I'm sure other panelists also have their comments. No, I'd agree that the threshold of 10 billion is quite high. And the whole argument around this provision was it ought to only apply going forward. Otherwise, when it has retrospective effect, and based on what we saw KRA's interpretation to be that actually overnight tax losses would have been extinguished, it does raise certain fundamental issues from a legal perspective. Right to property, tax loss is an asset, and there may have been a policy rationale behind the threshold, but what we're expecting is a very clear transitional provision which clarifies that this provision only applies going forward. Otherwise, what we're likely to see in the coming days and months is probably more disputes arising out of KRA's attempt to claw back tax losses, which they will want to argue are extinguished because they interpret the 5-year provision to have applied retrospectively. And again, it's a necessary dispute which could have been cured by a more straightforward amendment and a carve-out to this provision. So I do agree, could have been done better, but some of those areas where we expect that there will be disputes in the next couple of years arising out of the older provision, which was introduced in the last Finance Act.
All right, thanks for that, Ken. There's another, oh yeah, I'm seeing Nicholas is here. Nicholas, you want to that? Perfect.
Yeah, thanks. Maybe just to chip in to what my colleague Ken has alluded to. Yeah, I do agree. It creates an fair tax landscape for people in the capital-intensive sector vis-a-vis now the people who operate in the normal sector. Because you'll find now the 10 billion threshold, it's quite steep, and it's most likely to incentivize the people around the capital intensive sectors, be it the high end of the top end of the manufacturing, be it the roads and the infrastructure, the energy projects that the government wants to embark on. I do see a clear strategy by the government just trying to incentivize people into the capital incentive projects. However, what it then lacks, and what Ken has alluded to here, it's that now you are now creating a level playing field, especially the normal taxpayers who also have a right to their assets. Remember, these tax losses are properties that they ought to utilize when they come and do business in Kenya. So maybe as a going forward, we will recommend we adopt the issue of having transitional clauses in our tax legislation as we now switch on, or as we amend the tax laws through the Finance Act or the Tax Laws Amendment Act. We do have transitional clauses just to protect the benefit that has been incurred previously, and then also to take into effect that we don't want any taxpayer to be antagonized there. And also this will assist in creating a predictable and well as a favorable tax regime or environment. Over to you, Presi. Thanks.
Thanks for that, Nicholas. Maybe just two more questions as we look to wind up. So I'm seeing a question here on royalties. And the question is, does this also affect companies whose businesses are in the heart of digital wallets as well? Because from the look of things, whilst they may not necessarily be targeted, they're the broader cousins to the card transacting businesses as well. Should they be concerned with this becoming their way as well? And secondly, the particular amendment regarding the mobile phones, do we see this coming up sometime next year, especially with the kind of positioning the government is trying to portray? Do we get that sense as well? I will push this over to, I wonder who can handle this in the panel. Was Andrew handling the royalties bit as well? Andrew? Or Beatrice, anyone who wants to respond to that? Ken?
I didn't quite get the question, but I think it's around
Okay.
the
Sorry about that. I
royalty.
we're gonna,
I can't see it in the screen though.
Yeah, it's just been texted, whether the
Okay.
royalties touch on companies that are in the digital wallet side of things, so the Pesa, PayPal kind of companies as well, or would these just be touching on companies that are sort of like card holding, as we've been told?
So that definition is very wide. So and it appears to have been drafted deliberately to be a catch-all provision for many transactions in the card and in the payment sector. So certainly worth looking at the contractual arrangements to understand whether this new definition would apply. But as I said, it's extremely broad, and it's probably the case that it may catch those types of transactions you just mentioned.
Okay, thanks for that. Maybe the last question that I see is a bit lengthy on the chat. So this is pertaining to the renewable energy sector. I think there's just a broad concern regarding where it's headed towards. So someone is stating the way so this is John Courier, the way there shifts. So he's talking about the Finance Act 2026 shifts clean energy taxation by shifting key renewable energy and e-mobility items from zero rated to VAT exempt. He's talking about the effect this has on businesses from recovering input VAT, and it has caused controversy by imposing the standard 16% VAT on subsidized items. And then he talks about other various challenges like solar batteries that are reclassified from zero rated to VAT exempts. He talks about the large capital investments as well in the energy projects that will see their capital allowance claims spread over 10 years in equal installments rather than being claimed fully upfront, affecting cash flow from massive green infrastructure projects. So I think the question here is, because he asked how renewable energy can be actualized, I think he just wants to get a sense of predictability from the tax side of things. Do we have any commentaries regarding the same? Do you share any sentiments too? I'm curious to know what the panelists think regarding this. Okay, Nicholas, I see you.
Yep, I can attempt that one, yeah. So in the recent past, we have had a new terminology coming from the Cabinet Secretary of the National Treasury, and this one is around tax expenditure, and they want to rationalize tax expenditure. And this one has been pushed upon or forced by the Bretton Woods organization, the IMFs and the World Bank. Yeah. And one of the key themes that the Cabinet Secretary has embarked on, it's around trying to curb the tax expenditure by reducing the tax incentives or moving items from the zero-rated status to a tax-exempt status or VAT-exempt status, and from VAT-exempt status to standard-rated, yeah? And these are some of the issues that our audience have picked, yeah, around renewable energy. From where I see it from, it's a much more of a balancing act by the government, yeah? Do you want to attract people around this capital-intensive project? If yes, be ready to stand on the incentives that you want them to come in. Because remember, the government has not the flexibility or the bandwidth to absorb debt and undertake these capital-intensive projects. They are trying to leverage on the PPP model just to ensure we create a predictable business environment for foreign investors as well as local investors to come in and chip in and undertake now these capital-intensive projects. Yeah, but you'll find in most cases, especially around the energy projects as well as the road projects, you'll find most business people will want certainty, will want predictability in the tax environment. And most of them, whenever they are signing these contracts to the government, they'll want it's called a tax clause or a tax stability clause in their contracts with the government. And if the government then renegates the position they had agreed with the investor in the first stance, then the investor has the recourse to go after the government and ask either for additional payments or prolonging of the contract, which again is counterproductive for the government. So as much as the government is trying to balance, we foresee a situation whereby we might see some more tweaking just to cut on the tax expenditure. But in the long term, I think the government has to either bite the bullet and say, I'm happy to give you these these tax incentives for us to spur development around the infrastructure space in Kenya. Thanks, Pressy. Over to you.
Thanks for that, Nicholas. I believe that's pretty much it. I see there are a couple of questions streaming in. I'd encourage members and participants to share this with us as well through our email that's already spread out there. And then we'll be able to send the same to our panelists, and then we'll be able to provide some concise and comprehensive as well responses to you. But in the interest of time, allow me to welcome our task force chair, Fred, who will then close the meeting. Over to you, Fred.
Thank you very much, Pressy. And I want to particularly thank our panelist, Nicholas from PwC. Thanks a lot for moderating that session. Beatrice from KPMG, Andrew from HHM, and Ken from Anjawara. We really appreciate the insights that you have given us this morning. Just 3 things for me to our delegates this morning. And I think this has been alluded to. I think one of them is that there's actually merit in engaging the policymakers on some of these things. I think if you look at the finance bill and you look at the Finance Act that we have now, there are quite a number of changes that have been seen. Some of them new introductions that are very positive, especially for the financial sector. Some of them removal of some of the proposals that were very adverse to the businesses today. But I do know that maybe even some of the members of AmCham, maybe some of the changes were not taken into account. But I really want to stress that there is importance of us engaging the policymakers to ensure that we actually see and shape the tax conversation in Kenya. And I think AmCham is playing a key role in that. Whenever there is call for submissions, I think there's always, a request from you as the members to submit, some of these points. So I really request you to continue engaging AmCham on that. Please continue putting in those particular issues. At the task force, we have a matrix of issues that we consider as priority, and we will continue building on that particular list and engaging the policymakers to ensure that we see the changes that are quite important. So from the conversation, you'll actually note that compliance is becoming more data-driven, and that's my second point. There's a lot of conversations on technology. Maybe there's no scope for the government now to increase the tax rates and such like things. So we are likely then to see a lot of enforcement, a lot of powers being given to the commissioner. And as such, as businesses, we then need to rethink our tax governance. Our controls within the organizations. So then we ensure that we are not caught flat-footed in the event that some of these enforcement measures face us in the coming days. So it is just to encourage us to move with the current times. Let's just take note that compliance is becoming such a big deal. Of course, that point is on predictability and certainty. I think from this conversation, you'll actually notice that as a country, we are still not yet there, despite the fact that we have very good policy documents. As I did mention earlier, we have a national tax policy. Probably very few countries in Africa that have actually made that public. I think after Nigeria, you would struggle to pick any other country in Africa that have made their national tax policy public. So, and we also have the medium-term revenue strategy. I think we'll have another medium-term revenue strategy that will lead us to 2030. But I think the key messaging that we continue putting out there with the policymakers is to ensure that we we actually do abide to this particular policy document, because that's the only way investors will probably take us seriously as we go forward. But I think for us as a task force and AmCham at length is just to ensure that we continue advocating for the government to pay fidelity to these particular documents. Now, looking forward, of course, we do expect them, as has been pronounced, we expect a tax laws amendment bill. I'm not very sure when it will happen, but as soon as it is tabled in Parliament, or we get rid of it, then we'll obviously engage you as a members through AmCham to see how we can shape that particular conversation. I think there's been pronouncement that there will be one very soon, especially from an income tax and pay-as-you-earn bands perspective, more specifically. And of course, the Finance Bill of 2027, we expect it to come a little earlier than usual. Ordinarily, it will be tabled in Parliament by 1st of May of every year. This year, because of elections being next year, we are likely to see it come earlier. So we expect to hear from us as soon as this is also tabled. Without much further ado, Tracy, I want to thank you and the whole of Secretariat, AmCham at large, for affording this particular opportunity, and thank our delegates for joining this particular conversation this morning. Back to you, Tracy.
Many thanks for that. I mean, what more to say after the task force just put this all out, but then we'll be happy to share a readout to the team as well, and we're happy to track the same. Very many thanks to you, Fred, and to all our participants for attending this. At this point, allow us to close. Have a very good rest of your day. I see our CEO is here. Great. I will then push it to our CEO to be able to close.
No, mine was just deep appreciation. Thanks, Percy, for the coordination. Fred and the panelists, really appreciate your expert advice, and just looking forward to another round. Thanks so much.
Thank you.